Hey everyone, it is Courtney from the Ivy Investor. We are going to talk about real quick, and not really, I don't know how real quick this is going to be, but we're going to talk about IRAs for every occasion. So you're probably thinking like, what does that even mean? So we're going to talk about a couple things. So the first thing that I want to get out of the way is kind of just a general disclaimer. Listen, the conversation I'm going to have today with you guys is that, we're going to talk about some really interesting tax strategies, some retirement strategies, stuff you should know, or at least have a good idea about. However, here's the thing. Here's the real big thing. Everybody's situation is different. Please, please, please seek out a tax professional if you have questions, and you should have questions about your specific situations and circumstances before engaging in any retirement or investment strategies, because some of the stuff we're going to talk about is heavy, 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 and you need some help. I don't want you going out there in these streets, because guess what? If you do it wrong, I'm going to tell you this, it's taxable. And some of these amounts in these retirement accounts, you don't want that to be taxable. Okay? All right, let's get started. So I want to start talking about the rollover IRA. It's kind of like the most common IRA that we talk about, but it's not, interesting enough, it's not really well understood. So basically, here's the thing. A rollover IRA is this. It is an account that allows you to move funds from your old 401k, 403b, 457, TSP, which is your thrift savings plan from the federal government, basically your employer plan, without being taxed. That's it. So you're saying, okay, I have this account over with my old employer. What I want to do is I just want to move it somewhere else. But normally, if I take money out of that account, like directly, I'm going to get taxed. I'm going to get hit with ordinary income tax. And if I'm under the age 59 and a half, I'm going to get hit with a 10% early withdrawal penalty. All things that I do not want. And also, it's, the bigger issue is that it's kind of taking me away from my financial goals. Okay. So let's talk about what this really looks like in practice. So basically, you have your 401k. It goes to the IRA. It doesn't really touch your hands at all. So there's going to be a check that says for the benefit of, in my case, it was Courtney Richardson. So it would say, E-Trade for the benefit of Courtney Richardson. Okay. But I can't go to the bank and actually cash this check that's in my hands. I just can't. There's nothing I can do about it. But you do have 60 days to do anything with the check that may be in your hand that the 401k company sends to you. So I tell people, just get the paperwork, get it in as soon as possible. But if you can, just have them do what's called an ACH, which is automatic or automated clearinghouse, which is basically like a transfer between banks, or even a wire. 9 times out of 10, I tell people I do not want the check. Don't send me the check. I don't want to see it. I just need to know that it made it to its final destination. That's it. So that's the rollover idea. So the things that I want you to consider with the rollover, the first thing is that, which is, I don't want you to what we consider commingling funds. And you're probably going like, what do you mean commingling funds? So when you have an IRA, you have the money coming in from your old employer plan, whichever it is, the 403, the 401k, 403b, 457, TSP, whatever that is that you're rolling over. But, you have your regular IRA contributions that you can make every year. And in 2020, it's $6,000 if you're under the age of 50. And then you have an additional $1,000, which is considered a catch-up provision, additional 1,000. So it's like 7. So under the age of 50, 6,000, over the age of 50, 7,000. You can contribute that. You can contribute it to this rollover IRA, but you are mixing or commingling qualified funds, which are from your plan, and non-qualified funds, which are not from your plan, which you can do. That's not a problem. But if you ever want to move these qualified plans or this 401k money, wherever it came from an employer plan, and you want to move it to a new employer plan, it is really completely up to your employer, your new employer plan, if they're going to take the funds first. And if they're going to take the funds and there's non-qualified assets, which basically we kind of call that kind of spoiling the pot, these non-qualified assets that come out of your pocket and put into the IRA. So what I really should do is I suggest that people keep their rollover IRAs separate than the money that they contribute to an IRA regularly. So that's my suggestion. Um, and then also, I want to, like, just as an easy practice point, I tell people they get so excited about doing a rollover. I'm like, but where is it going? That's a really big issue. So I tell people, set up your rollover account to receive the funds before you actually start the process. So that, because again, if you're trying to do a rollover, it has to go somewhere. And remember how I said that you're going from 401k to IRA. So again, it has to be E-Trade, Merrill Lynch, TD Ameritrade, Vanguard, whoever, for the benefit of you. So there has to be a setup. So kind of, they'll basically not cut the check for you. They won't. Or you can do what's called like an indirect rollover. So they'll keep 20% of the money as a withholding. You put the 80% somewhere in the account, and then you put your own 20%, and then the IRS at tax time reimburses you. You don't want those problems. So just in short, set up your IRA, the rollover IRA first before you start the process. So it's all ready to go. You get all the account information so you can get the ball rolling as quickly as possible. Okay, so let's move on. The inherited IRA. So you're going to notice like a theme, like as we go, like as this conversation continues, is going to get more and more complex or complicated. So, like I said, there's an IRA for every occasion. In this case, this is actually the worst type of occasion that can happen, which is the death of someone who leaves you something. So, an inherited IRA is an account that is open when an individual or a beneficiary, that's what they're called, inherits an IRA or an employer-sponsored plan. Like I said, the 401k, 403b, 457, TSP, after the original owner dies. Okay. So that's what happens. This is a account that you receive as a result of somebody's death, and it's usually somebody you care about. Usually, and that's kind of what makes it so frustrating. So here's the thing. So basically, we have grandma's retirement account. So again, we have the whole situation is that it's going from grandma's retirement account to an inherited IRA. And the reason why it can't be a rollover IRA or any other type of IRA is because there's certain rules about these. So here's the thing. With these particular rules is that there's what's called a 10-year rule. So the funds, and this is the Secure Act, actually changed the whole game about these particular accounts. So before the Secure Act, what you could do as an IRA beneficiary, inherited IRA beneficiary, getting it from some kind of a loved one, we'll call them a loved one, you could basically kind of space out the payments. You can make small payments every single year to yourself to basically satisfy what we call the required minimum distribution, because it's based on your lifetime. And if you're young, then your required minimum distribution is going to be a very small amount of the account. But here's the thing. This is before the Secure Act. Basically, that account could just grow and grow and grow so big because for the most part, that money is being invested or still invested. So you're really getting the benefit of kind of time in the market. The Secure Act said, hold on, we're not doing it that way anymore. We're not doing this whole lifetime stuff unless you're a spouse, when you can use the IRA for yourself, like you would. Like if you're a spouse and your spouse passes away and they have an IRA or some type of employer account, you can use it as your own. So you basically can roll it over in your name. Okay. Now, if it's a minor child, this rule does not apply. So if it's a minor, a smaller child, like a child under the age of 18 upon the death, completely different situation. Or if you have a person who is disabled, this rule doesn't apply. But everybody else, this 10-year rule applies. So it means you have to have the entire balance of the account completely gone by 10 years. So a lot of people are just like, depending on the situation, this is where you have to get your tax person in. A lot of people say, well, we're going to hold off. Some people say we'll hold off for 10 years. Other people say we'll take a little bit out every year so I don't get hit with a huge tax bill. Because remember, these funds, like I said, ordinary income. So these funds are not going to be subject to a penalty, but you're going to get ordinary income. So this is going to be part of your income. So if you make $100,000 and you're taking a distribution out of the IRA because you have to, of 100, another $20,000, that may change your tax bracket and really affect how much money you have to pay in taxes. So again, why? It's so important for you to have a conversation before you engage in this type of transaction with your tax professional. Because once these transactions are done, a lot of them you can't unring the bell. So once it's done, it's done. So it's easier. It's kind of, it's easier pretty much to measure twice and cut once. So that's what I suggest. Measure twice, figure out what you're going to do, figure out the plan, engage a professional, and then cut once. Okay. And the reason why I even want to talk about this is that there is what they're calling the great wealth transfer between baby boomers and millennials, and it's supposed to be the greatest wealth transfer in the history of the United States, because baby boomers are supposedly the richest generation. Okay, that being said, about $30 trillion is going to be transferred. So that's huge. So there's definitely going to be money coming. But the thing is, you have to know what you're going to do with it, and you have to have a plan, because like I said, it has to be gone in 10 years. And if not, you're going to get hit with a crazy excise tax, or basically like a penalty. I believe it's half the balance of the account. I'm not sure. Don't quote me on that. I didn't do my research on that aspect, because I know y'all are going to pull this money out before 10 years is over. But again, you have to structure these plans, or you really have to structure how much money you take out every year, because of the tax implications. So definitely, once somebody passes away and you find out that you have one of these accounts, what do you do immediately? Go talk to a tax professional. Okay, that's it. And you guys will come up with a plan. I prefer enrolled agents and CPAs. You'll come up with a plan to actually deal with these assets in a way that makes sense for your tax situation. So finally, we have the self-directed IRA. Everybody's like really excited about these. These are kind of like the sexiest IRAs, but whoo child, can I tell you that these are a very problematic account if you do not know what you're doing and you don't have a professional. Do not do this by yourself. This is not a DIY situation. Even still, you have to have what we call a custodian or a trustee on the account where the IRA is held. But even still, you have to engage other professionals, because this gets really crazy really quick. So real quick, a self-directed IRA is an individual retirement account that allows investments outside of stocks, bonds, or mutual funds. So it allows real estate, LLC, certain precious metals, not everything, but gold, silver, palladium, and platinum, and more. So that's the self-directed IRA in a nutshell. A lot of people like to use it for real estate. So let's just look at it. So self-directed IRA, think of it as a basket. And in that basket, you're holding real estate. And a lot of people think like, oh, I have this 401k sitting over there. I really don't want to invest in this money or use this money to invest in the stock market. I want to invest in real estate. But I'm going to have what I need to do, what they think they need to do is, I have to pull all this money out of my 401k or my IRA and pay the taxes and invest in real estate. No, you don't have to do it that way. You can actually do a self-directed IRA, but there are some things that you really have to consider. And I can't really emphasize this enough. The first thing, you are on your own. I was going to sing some Patti LaBelle in honor of the Patti LaBelle verses with Gladys Knight, but I'm not going to embarrass myself. Okay, but you're on your own. So you're selecting your own investments, which a lot of people do generally, but you're really selecting your own investments. So definitely, if you're looking to do real estate, you need to get a realtor involved. Okay. Also, there are a couple of different trustees. There's Equity Trust. There's a couple of them that are out there that you may want to look into to actually hold the account, because you still need a trustee. You can't hold this in your hands. You can't have this at your bank account. It has to be held somewhere especially. So definitely engage professionals across the board. One, definitely engage a tax professional. We'll talk about why this is so important, especially with this account. But then also invest. If you're doing real estate, you need to have a real estate agent on deck. And so that's the first thing. Now, here's the other thing. Even though these accounts are considered tax exempt, self-directed accounts may be subject to tax because of unrelated business income. And you're probably going like, all right, well, what's that? Well, it's anything that's not like focused or really specifically for retirement. And you're like, well, Courtney, it's in my retirement account. Why would it not specifically be for retirement? Well, it's kind of like the business that you'd be engaging in. Like we could always think in a retirement account, you're going to do investments. That's a given. But are you going to be really running a full-term business in your investment account? Probably not. And if you are, it's probably something that's not really contemplated for you to be doing. So they said, listen, if you're going to use financing to acquire a asset in your IRA, that's allowed, and we'll talk about prohibited investments in a second, you're subject to UBIT and UDFI. And you're going, what? Okay, hold on. So UBIT is unrelated business income tax, and UDFI is unrelated debt financed income. So basically they're saying, hey, if you've purchased a property and you used some outside funds, like you secured a loan from outside sources, this is not all coming from your IRA, they're going to say, okay, that is unrelated business income to the extent of the loan. Okay, so if your UBIT, so say you have a property, $200,000, $100,000 of it comes from your IRA, the other $100,000 comes from financing. Okay, fine. So here's the thing: your unrelated business income tax, any of profits that are going to be derived from the portion that's financed is going to be considered unrelated business income, so it's going to be taxed. But then you have unrelated debt financed income. So same kind of concept, but just different idea. So it's, but for it to be taxable, it has to be debt related to the purchase of the asset. It has to be, you have to receive income from the financed property, and the production of income has to be unrelated to the tax exemption. So basically, purchasing a property with debt is going to get you in these boxes, okay? So just keep that in mind. And then finally, you have some prohibitions that are like, whoo, if you violate them, you have real live problems. Okay. So here's the thing. Let's just kind of talk about that for one quick second. Okay, so we have these prohibitions. So here's the thing here are the rules, and we'll go into the rules in a second. So you can't engage with any transactions in your IRA with disqualified persons. That's the first thing. The second is that you can't get any personal benefit from the assets in the account. And also, you are not able to basically you're not able to do any of the work. So any work that you have going on, you have to hire somebody. Like you can't do it personally. So just think of it that way. So you have, when I talked about you can't engage in prohibited transactions with disqualified people. So let's talk about prohibited transactions. So first, the investments that you cannot invest in. You cannot invest in what's called collectibles. So no antiques, no S corps, S corps aren't collectibles, but no antiques, no stamps, no art. Then you cannot invest in S corps or life insurance as investments in your retirement account. So so that's kind of one thing. But then you have disqualified people. So you and your spouse, you're disqualified. So you guys, for example, you can't live in the property that's owned by your IRA. But you know who can? Your cousin. Strange, random rules. Don't know why, but whatever. So here's the other thing. So you're saying my cousin can, but I can't? No. And neither can what we call your lineals. So your children and your parents, grandparents, whoever, that whole line cannot get benefit from the asset in your IRA. And then also any entity where a disqualified person. So they're like, listen, you can't get around it either. So don't try to shelter yourself by being a member of an LLC and having like the majority interest. So any entity where a disqualified person, the people that talked about you, your spouse, your lineals, have a 50% or more stake in the business, can't invest in that. And then so an entity where the IRA holder, like you, own more than 10% of a business or kind of have like a controlling aspect of the business. Nope, not you either. And then finally, um, that's pretty much, like I said, you can't do the work at your property. You can't just say, oh, well, I'm a contractor, I'm just going to do the work. Nope, because you really can't get any benefit from this property, or you can't get any benefit beyond it being an investment. So that's kind of like the overview about all the IRAs that kind of what I call millennials should know, or the IRAs for every occasion. You have your rollover IRA, you have your inherited IRA, and you have a self-directed IRA. And all of them, as you can hear, have rules upon rules upon rules. Always, always, always consult with a professional to make sure that you're doing things the right way and you don't get jammed up. Because again, once you make a transaction in some of these accounts, you cannot undo it. And it may be like the results could be devastating in terms of tax consequences. And you basically also derail your whole retirement goals. And that's not what we want at all. So definitely here's some information for you guys to chew on, and also have a conversation with your tax professional. Like I said, EA, which is enrolled agent, the CPA also. You guys have a great day. Have a great night. I hope you get some value. And if you do, please subscribe and please share with all your friends. Talk to you guys soon.